Welcome back, guys, to another roundtable. My name is Adam. Right next to me, Victor.
Hi, everyone.
And across me, Rusmin,
Hello.
Kenny. Thank you, guys,
Hello.
once again. So thank you for joining us for this roundtable. And today we're going to talk about REITs. All right. So I think we're going to focus on one particular class of REITs, which is healthcare. And you know, over the past year or so, COVID-19 has been a real bummer. But healthcare is one industry that's been doing really well because it's a pandemic, right? And the healthcare REITs are doing well. All right, so Parkway Life REIT has been one of the best performing REITs for the longest time. And we're going to compare Parkway Life with another healthcare REIT, First REIT. All right, and we're going to compare the differences in performance and why one REIT is doing so much better than the other REIT. All right, so just to give you a bit of a background, Parkway Life has been, since its IPO, has been growing, I think, 250%.
In terms of net return.
In terms of net returns. So that's a tremendous performance for Parkway Life. But for First REIT, it's not doing so well, right?
They have actually lost in terms of value is about 3/4 of their value since IPO.
Since
we exclude all the dividends that they've received so far.
So the question is, how come one REIT, they're both healthcare REITs, they own hospitals, all right? We're going to dive into that really soon. But one has been going this way and the other one has just been going down. And we want to find out the reasons why one REIT is doing so well, even though they're both in healthcare. Right? So just a quick background of what the business of Parkway Life and First REIT, what they're like. Tell us a bit more about that.
So you look at the business of Parkway Life REIT, they're essentially a trust, right? Real estate investment trust. They own hospital assets, mostly in Singapore. So they have Mount E, which is located at Orchard Road, right behind Paragon Shopping Mall. Basically, it's a bustling
Very
street.
expensive hospital.
Yes. And then they also have another hospital that's nearby, Glen Eagle Hospital,
Also
which
very
is
expensive.
also very expensive. And they got a lot of
Basically,
Indonesian.
they own all the expensive hospitals.
So, and right in the east side at Joo Chiat area, they also own, I think, Parkway East Hospital, right? So basically, Singapore assets actually account about close to 60% of the entire portfolio in terms of gross revenue, the rental income that they collected, right? And then they also have a bulk of their asset in Japan, like nursing homes, that actually account about 41% of the entire portfolio. And of course, they have one asset in Malaysia, which is accounted less than 1%. So I will exclude that.
So most of Parkway Life's assets are in Singapore, and then they have nursing homes in Japan.
Yep.
So they're some of the top-notch hospitals in Singapore.
Yep.
Okay, so what about First REIT?
First REIT, on the other hand, I think they own most of their hospitals mainly in Indonesia, right? So they have, I think, about 15 hospitals over there. 3 of them are integrated. So most of their assets are based in Indonesia. I would say, I think, close to 90%.
94.3.
Okay. So, like, based on first glance, it kind of looks like, hey, is it just because of where First REIT is located in versus Singapore? So, versus Parkway Life, which is in Singapore. Is it just a simple reason because the hospitals are in Singapore versus Indonesia that explains the difference in performance?
Yes and no. I think you look at the leases for both of these REITs, right? I think most of them have 15 years, 15 plus 15 long-term leases, right? And they usually lease out to a master tenant. Right, and then they're going to engage a hospital operator to come in. So in the case for First REIT, they actually engage Sholam Hospital to come and run the business for them while they just own the asset and then lease it out, collect rental income. Right, and if you look at Parkway REIT's kind of hospital, they lease out to Glen Eagles and all that. And their leases are also very similar, 15 plus 15. Even for the nursing home, it's actually more than 10 years long. Right, so in terms of lease period, I think it's quite similar. And then of course Parkway Life also, they have the rent built-in escalation, 1% plus the CPI, the consumable price index. Because it's kind of nice that every time they renew, they will increase the rent by 1% or more than that. Right, it's likewise for, I think, First REIT.
First REIT is about 2%.
Yeah, about 2% there about. Yeah, so the main differences why one outperform and the other one actually underperform is mainly because of the fact that First REIT actually collect their rent in Sing dollars, while their assets are in Indonesia. By right, if you're an Indonesian hospital, you pay a rent in rupiah, right? But not the case for First REIT. Since when they went IPO, I think the sponsor was quite generous, in a way that they say, we're gonna take on the forex risk ourselves. We're gonna give you the best for First REIT. So those early investors of First REIT was very happy because they get a deal where they collect rent in Sing dollar. They don't have to take on forex risk because we know that Sing dollar against rupiah can be very volatile over time.
And to put into perspective, the rate at the point of time that the sponsor give was actually $1 Sing to 5,623.5 rupiah. Okay. But now the rupiah is about 10,000 plus to $1 Sing.
Yes. Yeah. So it has depreciated so much, and now their leases are actually up for renewal. Right. I think this year, next year, I think they are actually negotiated on the term, and which is not so favorable because I think the sponsor are now having trouble paying off the rent because they have got themselves too much debt, and they also run into some liquidity issue before COVID-19. Yeah. So
that's why they recently recapitalized on the whole REITs, right? And they renegotiate on the not the SGD but turn it to rupiah now.
Okay.
Yeah. So COVID-19 certainly does affect everybody, right? I mean, but the thing that we seen in the first REIT is that they kind of give rental rebate to the tenants, which is the sponsor. Okay, so if you look at the lease closely, how they arrange the lease is very simple, right? I mean, for Parkway Life REITs, very clear cut. For Singapore Hospital, they pay the rent in Sing dollar, so they master lease it to their sponsor, which is Parkway, right?
Parkway Health, right?
Parkway Health, right? Which is owned by IHH, which is the owner. I mean, for sovereign assets of Malaysia. And if you look at their nursing home, they pay in yen. Of course, they will hatch it when they convert it. So that kind of quite stable. But for first REITs, they pay the rent in the tenant pay the rent in so-called rupiah. And then the REITs itself collect in Sing dollar because the sponsor agreed to pay in Sing dollar. And because over the past 14 years, the rupiah has appreciated so
by
much.
4.7% per annum.
Yeah, so it's kind of crazy, and they actually suffer huge losses. And because of that, this lease is basically not sustainable. So now they are coming back to reality. Hey, now we're going to under renewal, so it's best to revert back to the current market rate in terms of forex. So after the renewal, the rental is going to drop, I think, easily 40 to 50%.
To keep in line with the current exchange rates between the Sing dollar and the rupiah, right?
And make sure that the master lessor doesn't default on the rent, because if they default on the rent, it's going to end up like the Eagle Hospitality Trust, which recently the master lessor actually defaulted the whole rent payment, and then the REITs got into liquidation issue. So now they actually file for bankruptcy.
So actually, you based on 2019, you should figure you drop about 38.5%. From 92.2 million to about 56.7 million.
Before taking into account dilution that they had.
So in terms of DPU wise,
DPU wise, the impact is actually a lot bigger.
The DPU will drop. Let's say based on the 2019, so you'll drop about 69.9%, close to 70% drop from like 8.6 cents to 2.59 cents, which inclusive of recently they do the rights and the restructuring of the MLA for both of the hospital, right?
So what you're actually saying is that, okay, for those who don't already know, these two REITs are listed on the Singapore Exchange. So they are both listed in Singapore dollars.
And they are healthcare REIts.
And they pay the dividends.
Very stable dividend. Actually, look at the performance of the DPU best before COVID-19. I mean, both of them actually has been paying a very stable and growing dividend year after year. Of course, Parkway Life REITs DPU will be a lot better as compared to First REITs, because I think back in 2010, First REIT actually issued another rights, which is again this kind of diluted that kind of performance, right? But so far, I mean, the first 10 years was a solid year for First REITs, and all of a sudden, last few years, suddenly investors start to realize that hey, the leases are not sustainable. It's kind of like inflated because it's subsidized by the sponsor. Right? Without people who don't look deep into the detail will not know these things. Right?
You have to find it in the IPO. It's stated in the IPO prospectus.
So actually,
expire in 2021.
So we actually had a lot of this question that were asked by a lot of our members who attended Dividend Machines. I think 4 years ago, a lot of them were very interested to invest in First REIT because it was yielding at about 8%. At a point of time, 8% to 8.5%.
I think almost every lesson people are asking, man.
So it's quite attractive for a healthcare REIT to gives you 8%. So I think those who came to the workshop, of course, we did tell them that the rent are not sustainable. You got to watch out for that. And I think for the last 2 years, things kind of speed up because you are very close to the renewal. In fact, renewal has already taken place. They kind of renew at a...
They renegotiated last year, November 2020.
So that kind of like, significantly affect their rental, which is
expected, you know.
Expected.
Yeah.
Not on the high side, because at the time we already foresee this coming.
It's
Right?
expected because you did your homework.
Yeah. I mean, we have
You
already
don't
been
read about
mentioning
it, you
it,
don't know.
for the past 3 years. You
Yeah.
know?
Yeah.
Like,
Yeah,
please
but-
watch out for first REITs.
But
you
it
know?
was one of the REITs that a lot of people were very interested to invest because it's a healthcare REIT.
Healthcare,
People are
yeah.
really interested.
Yeah, I think if you go to, the dividend machines when we run it, because a lot of people are interested in healthcare. Because Parkway Life is like a lot of people know is a great healthcare REIT. It's super stable. I've been to the AGMs 4 or 5 times myself, and it's one of the most boring AGMs because every single year they're doing well.
Yeah.
So it's boring in a sense, which is great, right?
Yeah,
I mean, whatever crisis also don't really affect them
And
that much, right?
So people are like, okay, Parkway Life is a bit expensive. Maybe the yield is only like sometimes 4% or less.
Yeah.
And they want to look at another healthcare REIT, and then First REIT comes along and it's also listed on SGX, it pays me in Sing dollars and everything. And they look at the yield is 8%, and it goes like, wow, should I invest in that? And then, but like what you guys are saying, if you don't look at the the details, you peel back the layers, and then you find and you understand that there's this forex gap between the rupiah and the Singapore dollar. It's not sustainable because the agreement is coming up in 2021.
Back then I did a check on Siloam Lam Hospital. Actually, they are still listed today on Indonesia Stock Exchange. They were paying a rent in Sing dollar about 20 million, and First REIT was collecting about 90 million in rent. So that 70 million comes from somewhere else. So which is the sponsor who actually agreed to pay for that. And of course, if you have a good sponsor, very solid, don't mind be a big brother and keep giving you money, that's fine. But now depots are very different compared to depots 10, 20 years ago, right? I mean, the new successor for Lipo, they're taking a lot more risk. They leverage out a lot, and when things don't go their way, now you see everything almost come to a halt, right? Lipo got into some liquidation issue a couple years back, and so of course they got the new sponsor OUE, which actually came in, I think, bought out the REITs manager. But then we look at the OUE also, the way they run the REITs also is very aggressive, and you don't know, when it's going to trigger the margin call and all that. Of course, if things go on smoothly, market goes up, usually it's a good thing, right? But recently, because of COVID-19, they have to sell one of the assets in US at a huge discount to the asset value.
Okay.
Yeah, because they were distressed, right? The cash flow it's not enough to kind of pay off the interest that they actually borrowed from.
And I think this roundtable, we wanted to do it because that, a lot of people think that REITs are a very stable investment. That you just pick a REIT, is more or less, steady.
I think they think it's safe.
It's safe, and and we wanted to do a comparison between, two REITs that in a sector is considered safe, which is healthcare. Everyone gets sick. You need to take care of yourself, and especially in COVID-19, right? But then, through these two examples, you kind of see that there's a case study where one REIT just doesn't do so well. And it's not just because it's a REIT, it has to be safe. You have to do your research and understand what's behind that performance or underperformance, and then you can make a choice between what's a better REIT for your portfolio. And if you're not doing that, you have to do it. So that's what we do during Dividend Machines. If you want to check it out, go to dividendmachines.com. It's open till the 14th of March if you want to find out how to invest in REITs and all that. So do check it out if you want to. But it's so important that people know what they're getting into before they put their money in. And this is a clear example of two very similar REITs. Not all similar, because Singapore and Indonesia, but it seems like a hospital is a hospital as long as they're high quality hospitals, right?
Yes.
But the way the deal is being structured, the way people, the unit holders are being paid, you have to understand all those things.
Even if, let's say, the COVID-19 didn't come, maybe we are still under the normal condition. I think First REIT is going to have run into this issue, the same thing. Not because of the COVID-19. Of course, they do give out rental rebate, but that was just a temporary issue. We all know that. Right? But the big issue with First REITs is the way they structure the lease. Right. Let's say, assuming that the leases are also sustainable, they pay everything in let's say local currency, you're going to get exposed yourself into a long-term risk of Sing dollar against rupiah, and that one you can't escape.
No, if you were to expose yourself into the local currency at that point of time, then I think your risk won't be doing well because the rupiah depreciate. So your DPU actually will drop.
So the sponsor tried to fix that by providing that sort of
for 15 years.
For 15 years, but then they just couldn't.
Now it becomes a stupid idea because it costs them so much money.
I think the COVID just accelerate it,
But I think
and force them to to really come ahead of time to really negotiate.
Or at least now their loans, their leases are structured in a more sustainable manner. But moving forwards, I think for people who are looking to invest in First REIT, they need to accept the fact that there's going to be a continuous risk of accepting the forex risk.
Yep.
Because previously this was bear by the sponsor. Now it's passed down to you because now they're paying the rental in Indonesia rupiah. Although they do say that they're going to increase that every 4 years.
Yep.
Every year it's going to fall
Yep.
4%. Yeah.
But I think you should not expect the same performance of the REITs, right? Collecting the same rental, right? As compared to the past, right? So in the past they are getting about 100 over million Sing dollar in terms of rental, right? So now their rent
First REIT, right?
Yeah, first REIT, yeah. So now because of the restructuring and the thing, right, and now they're collecting in rupiah, right, their rental coming forward, right, going to be about 50 over millions, right?
Oh, tough.
And it's going to take them all the way until 2035, right,
That's a long
to
way.
hit back to 100 million. So that's the issue now.
Okay, so that's basically the main reason why First REIT the share price has just come down so much.
Yeah.
And assuming this is assuming that because they put a base rental escalation, right, at 4.5%.
Yeah. To
Buffer the rupiah
forex
of
risk,
4.7%. So this is assuming that the rupiah, not depreciating or something like that,
then you depreciates by 4.7, but you have a rent escalation to cover that up.
Yeah. Yeah, so in the end it's like, not much of a difference, After that you take, so many years to get back to your 100 million again.
Okay.
Right.
Yeah. All right.
Well, there are many other reasons why Parkway Life REITs outperform First REITs, but this is one of the key main things that happened recently that triggered the whole thing.
So I mean, some investors could have a look at First REIT and go, hey, but it's still paying me at this point. Okay, we don't know what's going to happen. Paying me a 12% yield based on all the
after the recap,
after the dilution and everything, paying a 12% yield based on it's quite attractive. Should I have a look at that? Because Parkway Life in comparison is going to be 3 or 4.
Yeah. Well,
what would you say to those people who are looking at an investment that says, hey, it's paying me potentially 12%. I want to have a look at that.
Well, the thing with recap is that if the manager is still the same, I don't think I'll put my money in them because it's going to be the same, right? The performance so far hasn't been good. And I don't think every recap you need to see there's a change of fresh blood of managers, and most importantly the sponsor behind every REIT, right? I mean the sponsor is still the same. Maybe you have a new addition, OUE, which is the brother of again the Yari brothers, the family. Both of them actually own, and the way they run it is very similar. And I just don't like the fact that how they actually run the REITs. I mean, this is just my personal opinion because the biggest difference between Parkway Life REITs and First REITs is that the managers are very focused. One is very focused on DPU, the other one is very focused on growing the AUM. So you know who is who, right? So I think that's just very clear. And I prefer to go for those managers that focus on growing DPU because that's ultimately where our return will comes from.
Actually, I think now you have two options, right? One option is a manager that perform very well, have a very good track record, and you know that the next 10 years you can believe this manager. Then you have another manager that screw you up one time, right? And hoping that you will give them a second chance, right? So which one do you want to go, right?
It's just very, very risky for them to focus on AUM because if you take on too much debt, what happens is right now they cannot keep up with the valuation So when the rental drops, what happens? The investment properties also drop. So the banks will not be willing to to loan them money. So they are cut out of the debt markets. That's why they have to do a rights issue and dilute the shareholders heavily through that. Yeah.
All right.
So I think Rusmin also talked about there's probably some chance that they will moving forward. They may do some right issue, am I right? Or
so far I think if you look at the past action, I mean First REIT has gotten used to issuing rights, and rights usually the cost of capital is very expensive. You need to issue them at a huge discount. Right. So I prefer placement over rights issuance. And you look at Parkway Life REITs, they really never issue anything before in the past, except of course they do have a cheap loans in Japan. So the cost of funding is about 0.5. No, it was lower. It's lower in 2019. It's a lot lower, basically less than 1%. It was as compared to First REIT is like 3-4%. That kind of cost of financing.
So if you want to really look at First REIT, then you must be prepared. If you give them a second chance, you must be prepared for dilution in the future, right?
Just prepare more capital in case they issue out more capital.
All right. Okay, so I think we did a really good roundtable for how to compare apple to apples kind of REIT, healthcare REIT versus a healthcare REIT, and how you go about actually doing that. So if you join us in Roundtable, I really hope you learn something about how you can go about analyzing a REIT. I mean, there's so many different REITs as well. There's retail, there's commercial, there's industrial, all different kinds. But there's still a process that we go through to basically, weed out the best and invest in that, rather than just trying to think that a REIT is always a safe and steady investment. So you always want to pick the best ones. So if you're interested to learn that, go to dividendmachines.com. But if not, thank you so much for joining us today, because I think we really did a good breakdown. I mean, there's still many things that we can talk about. But there's we just there's so much we can fit into a round table. So thank you once again, guys.
Thank you, everyone.
Yeah, thank you. Thank you for joining us. And again, if you like this roundtable, feel free to just subscribe, like the video, and subscribe to our channel. And we'll see you around again.